Welcome back to Management 416. In this video lecture, I will be covering the Balanced Scorecard, which is what I will use to grade your simulation performance. The Balanced Scorecard was first introduced in 1992. Since then, it has enjoyed a rapid rate of adoption in a variety of industries. More than just a grouping of financial measures, it is a strategic assessment tool that can accurately portray the business unit's strategic progress. The idea behind the Balanced Scorecard is that financial metrics alone do not paint a comprehensive picture of a company's performance and health. The Balanced Scorecard asks managers to consider their business from 4 perspectives. Financial. Are you maximizing the profits of your corporation? Internal business process. How efficiently do you run your corporation? The customer. How happy are your customers? And learning and growth. Are you maximizing the potential of the human capital of your corporation? The simulation includes many measurable and actionable variables that can measure performance in each of the 4 areas of the Balanced Scorecard. I will now go into the simulation and illustrate where you can find the Balanced Scorecard and demonstrate how it works. I have undone any decisions I made by going to Undo and undo to the start of round. I am now at the start of round 1 with no decisions made. Under Proformas, I can find a Proforma balance sheet, income statement, cash flows, ratios, as well as the Balanced Scorecard. Here is the Balanced Scorecard. We have our 4 areas of financial, internal business process, customer, and learning and growth. And within these 4 areas, we have metrics to measure performance in each individual area. For example, for the financial area, we will be measuring performance with the stock price of your company, your profits, and leverage. For the internal business process area, we will be looking at contribution margin, plant utilization, days of working capital, stockout costs, and inventory carrying costs. For the customer area, the simulation looks at customer buying criteria, customer awareness, customer accessibility, product count, and sales, general, and administrative expense. For learning and growth, the simulation looks at the employee turnover rate. There is also an area that's called a recap. Recap criteria evaluate your company's overall performance, and they're only finalized when your simulation is completed. However, you can always see interim results that chart your progress towards those ending goals. Your overall score for the Balanced Scorecard will include 8 rounds of how you did on these metrics, plus the recap for the last completed round. You can see here that the recap has other performance measures than the Balanced Scorecard. Now, how do you use the Balanced Scorecard to do well in the simulation? You can see exactly how you will be graded by the simulation. For example, for stock price, you can click on View and it will bring up a new window. You can see here that you receive no credit for a stock price under $2. You receive partial credit for a stock price between $2 and $32. And if your stock price is over $32, you will receive full credit. For profits, you can see that you receive no credit if you have less than $1 million in profits that year, partial credit for profits between 1 and 7 million, and full credit for profits over $7 million. In terms of leverage, which we will discuss later as well, you receive full credit if your company has leverage between 1.8 and 2.8. You receive no credit if your leverage is lower than 1.3 or if it's higher than 4. Under internal business process, we have contribution margin, plant utilization, days of working capital, stockout costs, and inventory carrying costs. For contribution margin, you receive no credit if your contribution margin is under 27%, partial credit if it's between 27 and 36%, and full credit if it is above 36%. Plant utilization, you receive no credit if it's below 90% or equal to 200%. You receive partial credit if it's between 90 and 200%. and you'll receive full credit for plant utilization between 100 and 180%. In terms of days of working capital, if you have less than 15 days of working capital or more than 105 days of working capital, you will receive no credit. You will receive partial credit if your days of working capital are between 15 and 105. You receive full credit for days of working capital between 30 and 90. In terms of stockout costs, which are lost sales due to stockouts as a percentage of overall sales, you will receive no credit if your stockout costs are over 5%, and partial credit if they are between 0 and 5%. Your inventory carrying costs are the costs of carrying unsold inventory as a percentage of sales. If this cost is over 3.5%, you will receive no credit. If it's between 1 and 3.5%, you will receive partial credit. In the customer area, we have the customer buying criteria, customer awareness, accessibility, product count, and SG&A expense. The customer buying criteria depict how closely your products meet customer criteria, sales weighted. If you receive a score of over 39 on the customer buying criteria, you will receive full credit. You receive a partial credit for customer buying criteria between 21 and 39. In terms of customer awareness, you get full credit if your customer awareness is higher than or equal to 90%, and partial credit for a customer awareness between 50 and 90%. The same stands for customer accessibility. For product count, you receive full credit if you have at least 8 products, and partial credit for producing 1 to 8 products. Concerning SG&A expense, you can see that you receive full credit between 7 and 20%, partial credit between 5 and 7%, or 20 and 25%, and no credit if your SG&A expense is lower than 5% or higher than 25%. And finally, for the learning and growth area, the simulation looks at employee turnover rate. Employee turnover rate is the percentage of your overworked and underpaid workforce that you lose each year. If you lose over 10.5% of your workforce in any year, you receive no credit for that year. If your turnover rate is between 9.5% and 10.5%, you receive partial credit. If your turnover rate is lower than 9.5%, you receive full credit. Right now, I have made no decisions for round 1. The simulation will roll over the decisions that were made in round 0. The score for the pro forma balanced scorecard for round 1 is 40.9 out of a maximum total of 82 points. I do recommend that you similarly look at the recap criteria since they are also taken into account for your grading. As a reminder, only the recap score for the last completed round will be used for grading. I want to spend a little bit more time talking about 2 examples of criteria used in the balanced scorecard. The first one is plant utilization. As we saw earlier, the simulation considers an average plant utilization between 100% and 180% as ideal. A plant utilization below 100% is seen as you underutilizing your assets, and a plant utilization above 180% puts you at risk of not being able to meet demand. So let's take a look at what our average plant utilization actually is at the beginning of the simulation. All you would need to do is take the average of the plant utilization here. And you would see that the average plant utilization is 75.2%. What was the range for plant utilization in which you could get full credit again? It was between 100 and 180%. So this suggests, even if we take into account growth year over year, that if you want to get full credit for plant utilization in round 1, you may have to sell some capacity. Let's take a look at another example, leverage. Leverage is a business term that refers to how a business acquires new assets for expansion. If a business is leveraged, it means that the business has borrowed money to finance the purchase of assets. Leverage in the simulation is defined as assets over equity. The simulation considers leverage between 1.8 and 2.8 as ideal, meaning that you will receive full credit if your company's leverage is in that range. A lot of people are adverse to debt, but to have perfect leverage, our company needs to have some debt outstanding. Students sometimes make the mistake of thinking of debt in terms of personal finance, where less debt is better. But a company uses debt to acquire income-producing assets, and its ability to acquire and use debt to its benefit is important. A leverage of 1 means that the company has no debt and is entirely funded by equity. Stockholders will wonder, why can management not invest earned money and make profits on borrowed funds? A leverage of 2 will indicate that half of the assets have been bought with equity and the other half with current and/or long-term debt. For every dollar of equity, there is a dollar of debt. This is considered to be the perfect balance between the two. A leverage of 3 indicates that for every dollar of equity, there are $2 of debt. A leverage of 4 indicates that for every dollar of equity, there are $3 of debt, and the company in this case is carrying too much debt. You receive no credit if your company's leverage is below 1.3 or above 4. Keeping in mind the perfect balanced scorecard range of leverage between 1.8 and 2.8, it is important to make sure that you balance how you fund long-term assets by raising money from share issues and bond issues, and that you start thinking of this early on. Remember, the simulation provides you with pro forma reports and annual reports. Both are specific to your company. Annual reports are the results from the previous year. The pro formas, which includes the balanced scorecard, are projections for the upcoming year. The pro formas provide you with a screenshot of how well your company will perform if your forecast is somewhat accurate. They can really be an excellent tool if used correctly and cautiously, and if the decisions that you put in make sense. In previous years, students have made changes to their forecast in order to make their pro formas look better. The quality of your pro formas depends on the quality of your decisions. The simulation will not check whether your decisions make any sense. For example, if you forecast to sell a lot of products, but this forecast is not realistic, the pro formas will look great, but they will not be a good predictor of your actual results. Let's say you put in an overly optimistic decision, such as your sales will double or triple. You will get unrealistic pro formas, which includes an unrealistic pro forma balanced scorecard. In addition to not checking whether your decisions make any sense, the pro formas can also not take into account the decisions that your competitors are going to make. Therefore, I recommend that you do analyze them, but at the same time, do not overly rely on them, and keep in mind that the quality of your pro formas depends on the quality of your decisions. Let's go back to the earlier, overly optimistic decision of doubling or tripling your sales compared to last year. The pro forma balanced scorecard will show an increase in profits, contribution margin, and potentially plant utilization. Your pro forma balanced scorecard will look so much better with this forecast. However, when the simulation processes and it turns out that your forecast was not at all realistic, your actual balanced scorecard on which your grade will be based will show poor performance because your actual sales will be a lot lower than your forecast. Always remember, the usefulness of your performance depends on how realistic your decisions are. If your decisions are not based on the Capstone career and your strategy, meaning they are essentially garbage, the performance will be useless. Since grading is based on the balanced scorecard, I recommend that you consult it often so that you understand how your decisions affect the different metrics. You should also consult your balanced scorecard after the round processes to understand how your pro forma balanced scorecard and actual balanced scorecard have turned out differently, and if there are large discrepancies, figure out why that is so.